Welcome to this edition of Financial Victory in Minutes. This video looks at how you can be a more successful homeowner and avoid the possibility of foreclosure. Okay, once you've accounted for all of your annual expenses and averaged them to a monthly amount, you now need to account for the cost of maintaining a home. One problem contributing to the home lending crisis is that most first-time home buyers don't have a solid written spending plan, much less budget for home maintenance. A general rule is that you should budget between 1% and 3% of the total value of your home each year for maintenance costs. So, for a $200,000 home, that would be $2,000 to $6,000 per year. Maintenance costs include lawn care and all manner of repairs to your home. Your water heater, furnace, roof, plumbing, and appliances all have a lifespan. In order to protect your biggest investment, your home value, you have to replace worn materials and items and do preventive maintenance, like painting. Great. Now you've made an accurate written spending plan that shows your actual spending on everything that's important to you, plus a reasonable amount for home maintenance and savings for your long-term financial goals. Now, and only now, can you see what amount you have left to make a house payment with. Now, and only now, do you know how much is really affordable to you. Forget those formula. You've done the work to know what you can afford, and now you're ready for step 2. Remember that your trust is always best placed in yourself. After all, you care more about yourself and your family than anyone else does. Loans with adjustable interest rates and payment options have caused so much pain. Always remember that verbal promises and assurances are usually worthless. You don't need to go to law school, real estate school, or business school to learn enough to protect yourself. Here are the basics. Real estate can be overvalued, and appraisers, especially appraisers being paid by the lender, can overvalue your property. You needn't become an economist to do some research on the value of the homes you're interested in buying. Before you buy, look at the property's current tax value and the dates and prices of prior sales of that property. Compare the property's age, location, and features to similar properties to see if the value is in line. Cost per square foot is a useful means of comparison. In many areas, all of this information is available online. The bottom line is that you don't have to rely on the bank's appraisal. The lender has a vested interest. They want to make the loan. If you're not 100% sure about your intended home's value, it may be wise to pay for your own independent appraisal. Especially in some areas of the country, home values were hugely overstated, and those values plummeted when the so-called housing bubble burst. That bubble was based on increases in value that couldn't be sustained because they just weren't realistic. Land and housing do increase in value over time to keep pace with inflation. But when we see values doubling and tripling in the space of 5 to 10 years, and the increases in value are way ahead of inflation, we should know that it's probably not real, and a correction is bound to occur. It's the same universal truth. If it sounds too good to be true, it usually is. Sure, some people made a lot of money speculating on real estate, and their timing was so good that they didn't get caught when the values corrected. But there were a lot of other people that weren't so lucky. You don't want to take that chance with your home. That's gambling your security and peace of mind. So before you buy, be certain your property isn't overvalued and that any increases in value over the last 10 years were reasonable increases. Another common problem is homeowners not being knowledgeable about all the costs that are rolled into their mortgage loans. Your mortgage is often financing a whole lot more than just principal and interest. Now, the law requires that we are told your loan's APR, or annual percentage rate. What many people don't realize is that the APR is not the same thing as the loan's interest rate. The APR takes into account all loan costs, so it's the best way to comparison shop mortgage loans. For instance, you might think that one mortgage is clearly better because it has a lower interest rate than another mortgage. But if there are points or origination fees rolled into the lower interest rate loan, it will probably have a higher APR and be a worse deal. The APR allows you to compare apples to apples on total loan costs. Now, most mortgage loans require you to pay an additional monthly amount towards an escrow account. Your lender uses the funds in this escrow account to pay your homeowner's insurance and real estate taxes. First-time home buyers often apply for and enter into a loan without realizing how much the taxes and insurance will increase their monthly payment. It can be a terrible shock if you plan on a monthly loan payment of $950, but escrow for the insurance and taxes makes the monthly payment $1,100 or more. Not knowing the additional cost of taxes and insurance can be a budget buster. So be sure you know the amount of your actual monthly payment, including any escrow amounts, and that this amount fits comfortably into the spending plan you made. Naturally, all homeowners should know whether their insurance and real estate taxes are included in the mortgage payment or whether they're responsible for paying it directly. Either way, taxes and insurance will have to be paid, and you want to know that they won't wreck your spending plan.